All right. So without wasting any time, we're going to start our webinar right now. Before we start, here is a small risk disclaimer for all of you. The information provided in the webinar is for educational purpose only and should not be considered as financial advice. The content presented in this webinar is based on the information believed to be reliable, but no guarantee is made as to its accuracy or completeness. Pupra and I shall not be held liable for losses, damages, or expenses incurred as a result of the use of the information provided. Trading and investing in financial market involve a high level of risk and is possible to lose all of your invested capital. Before making any investment decisions, it is important to carefully consider your financial situations, investment objective, risk tolerance. All trading and investment decisions are solely your responsibility. Participants should be aware of the risks involved and only trades or invest funds that can afford to lose. And just a kind of reminder, CFD forex trading can consider as a high risk investment due to high level. Make sure you have a very good risk management strategy throughout your trading journey. We do hope that you have a very happy trading environment in our platform or stay with us in all this trading journey. All right. So small risk disclaimer. So we are going to start now. For tonight's topic, we will talk about the economics calendar, one of the most important things for new traders to understand, because normally some investors, some traders will try to utilize the economics data and trade on news to profit from it. But there will be also some new trader or experienced trader, they would like to avoid economics data. So before this data release, they don't know what will be going on next. That's why they avoid trades to avoid significant volatilities in the market. So it should be quite interesting topic for everyone because it can be utilized for all of the traders around the world. This is the highlights that we are going to talk about today. The first thing, we will let you understand what is the importance of economics data in forex, in commodities trading. And after this data release, why there will be a significant movement and what's happened and how can you strategize nicely your trading strategy. And then we also talk about key economics indicator, let you understand certain specific most important economics data that we need to understand, which including GDP data, inflation data, as well as employment. We will talk about the CPI data, core PCE data, which going to release later this week, as well as the PPI data. And then we also talk about the non-farm payroll, one of the major crucial US economics data, the jobs reports. And we will also do some case studies, show you after this data release, what is the major effects in the market. We will use the consumer price index as an example for you guys. All right, so consumer price index, after they release, what should be the movement for gold? I will also let you guys understand later, and then we will stand together and analyzing future economics data. Because we do notice that in this week, we do have a very important data, which including the US GDP data, which due to release on Thursday. And then another data is core PCE price index, another Federal Reserve preferred inflation data, which going to release on this Friday. So this data is going to trigger a significant movement. Later, we will try to analyze how should be the data performance and how can we strategize from it. All right, so this is all the highlight that we are going to cover today. So the first thing, why economics data matters. So why is the economics data very important for everyone around the world, especially for new trader, experienced trader? So for example, especially for forex trading or gold trading, right? Normally investor will try to choose why will the fall up or go down. It's normally because that country economic performance is very good, and that's why they attract a lot of capital inflow. Or to put in a simple term, is that's why a lot of people are willing to invest in that countries. So for example, if you are from Thailand, you feel that, or maybe as a comparison between Thailand, Singapore economy or Malaysia's or Philippine economy, you want to choose what is a good country for you to invest. For example, if you feel that currently the overall economic performance in Philippines is very good, and you want to invest in the country, of course, you need to convert your Thai baht towards the Philippine currency, or you want to turn your Thai baht to Sing dollar if you are interested to invest in Singapore. So when you convert your currency, which means that you are selling your own currency, buying others' country currency, this will normally cause that currency to go up. So to put in a simple terms, normally investor will try to buy or invest in a country that are their economic performance is very good. So if the country attract a lot of people to invest on it, their currency normally go up. And if economics good, currency normally will appreciates or going up. So this is why economics data matters. Because for example, if I just assuming maybe Singapore economy is doing very good as compared with Malaysia, but how can you justify it? How can you understand why is the Singapore economics is very good? So by doing so, you can utilize the economics data to understand. It's very simple. You just data comparison. You just look through, for example, US. You want to compare which economy is doing well, compare with US, as well as United Kingdom, UK. So you just look through overall US economics data. What is the GDP performance? What is the CPI data performance? And then you compare with the UK economics data. So for example, if you can notice this is a dollar chart because recently most of the US economics data give a very good reason. That's why dollar continue to going up. But as comparison with UK economy, it's not as good as expected. That's why pound sterling is dropping. Because now, as comparison, US have a better economics performance according to the economics data. That's why a lot of people try to invest on it and then currency going up. So economics data is for us to identify, to receive the information about what is the country's current economic conditions, along with the future prospect of that country's economy. So to understand whether the situations, the economic performance in that country is good or bad. So we do it a comparison. So normally, if better than expected data release, their currency normally going up because it will attract a lot of investors to invest in that country. All right, so you need to try to understand it. And then this data release, right? There should be trigger or significant movement. Later, I will show you the historical example. And that's why for new traders, when you are not preparing on it, you might be experiencing significant losses if you don't set stop loss or like stop loss. So you need to be aware of it. You can try to do trades during economics data release, or you can try to avoid it until certain few events that happens. Then you can get, after you get prepared on it, then you play with a small amount of your capital. All right, so economics data is how we choose country. We normally investor will choose what countries to invest depends on the economics data, which will cause the significant movement on the currency. So I know there are tons of the economics data around the world. If you open investing.com or Bloomberg, you can notice there are a lot of economics data that are released every day. But here is the 3 key summarize of the economics data that you guys need to be understand on it. So normally, if new trader, basically you just understand these 3 major economics data should be enough for you to do the trades or justify whether which country's economic performance is good. So we will use these 3 main data, including the gross domestic data, GDP data. We also talk about the inflation data, another very important economics data. And then we will also explain about the employment. So in Thursday, we do have the crucial GDP data that we need to be focused on it. So normally after this data release, dollar is going to experience a significant volatilities that I will explain. So the first thing, GDP data, what is gross domestic, or another way, GDP data? To put in a complicated explanation is gross domestic products, GDP, is the total value of all goods and services produced within a country's borders over a specific period, typically measured quarterly or annually. And to put it in a layman terms, GDP data is one of the good economics indicator to identify which country is richer, very rich. For example, if GDP data maybe in US is very high, which means that the people in United States is very rich, the country is very rich, they gains a lot of money. So GDP equals to the profits that the countries are earning in layman terms. So normally if this GDP data release and the result is very good, the currency will normally going up. Or maybe if, for example, if US GDP data release is very good, a lot of investors might have the confidence to invest in US. And then when these things happens, dollar might be going up. And if the economy's performance is very good, it will also trigger some sell-off for the safe haven asset, such as gold as well as silver. Because when one particular country economy's performance is very good, they will attract a lot of investors to invest on it, especially invest in the corporate company stock markets, invest in their currency, invest in their property. But normally they might be considered selling off safe haven asset, because safe haven asset like gold, normally high risk or economic performance is not good, people will invest in it. But if economic is good, normally people will sell off safe haven and then invest in other risky asset. All right, so GDP equals to an overall economic outlook in specific countries. How rich is that country can be identified by the GDP. So when GDP is good, indicate a robust and growing economy, signifies increased economic activity and potential for expansions. Put in the simple term is good GDP result, the richer country, currency might be going up. So when to invest if GDP result is good? So equity market might be going up because good GDP means a lot of people richer in that country. They will likely to spend more of their money. So when they spend their money, they will buy something, right? Of course, as a company perspective, you might earn more when your consumer become richer. So if you might gain higher revenue because more people purchasing your products because they are richer now, and then profit will be also gained. So normally, if GDP is good, there will be chances for equity market might be going up, especially consumer discretionary products, such as like luxury goods also, or like normal goods also will be benefits from it. All right, another thing is commodities. Better GDP result may drive up commodity demand, such as crude oil. So for example, if you become richer already, right? It means that you gain more money, you gain more salary. The first thing you want to do is you want to travel around the world. You want to play around the country. So richer will cause you to play more, travel more. So when you travel more, you will travel around the world by aeroplane, right? And then oil will normally use as a fuel for those airplanes. So when people become richer, more travel around the world, demand for oil should be going up because a lot of people want to utilize the airplane to fly towards other country. So when these things happens, oil price will be also normally going up. And if we are going to look at the oil charts, historically, previously, why is the oil price keep dropping previously? It's mostly due to the worse than expected Chinese economic performance. Because previously, after COVID, the Chinese economic recovery are not as good as expected. That's why, and just a kind of reminder, China can consider one of the major oil importer around the world. They should be considered like top one or top two oil importer around the world. They purchase a lot of oil. So if Chinese economy is not performing well, the chances of purchasing the demands for the oil might be declined. This is the reason why the oil price keep dropping. But after that, Chinese economy recovery start to show some very good reading. That's why oil price start to rebound. This is the latest proof. And then of course, demand side is one thing. Another side is regarding on the supply, which is what we talked about. The rising Middle East tensions will normally cause the supply disruptions in the world. So the oil price is another big fundamental to support oil to going up. But we'll talk about it during the next webinar. All right. So now you already understand GDP is not only going to affect currency, it will also affect stock market, which is what I call the equity market. It will also affecting the oil market as well as the gold market. Because GDP is good, safe haven might be dropping, investor might be shift their portfolio towards a much better than better choice, better risk, higher returns products. All right. Next thing that we will talk about should be on the inflations. Inflation is also one of the main things that we need to focus on it in 2024, because this is a hot economic data, and the Federal Reserve, right, normally will keep using the inflation data to determine whether they want to increase the interest rates or decrease the interest rates. So inflations will normally affect the interest rate decisions. Interest rate decisions will affect the currency movement aggressively. So normally, traders will try to identify the inflation rates. Then, after you understand what is the inflation's outlook in such specific countries, then they will try to predict what is the monetary policy decisions they will try to do, and then they will try to strategize their investment decisions. So, for example, if inflation is very high, normally the central bank will likely to increase the interest rates, so the currency will normally going up. So this is what we look at on the US dollar previously. If you guys remember here, during COVID time, the Federal Reserve decided to lower down the interest rates, but after that, after COVID recovery, the US inflation's almost hit 10%, more than 10%. So the central bank decide they want to stabilize the inflations from 10%, they decide to increase the interest rates. And then the trends for dollar from here to here, these huge trends, is just one big fundamental to support it. It's fundamental regarding on the Fed. They say they want to increase the interest rates in order to stabilize the inflation. So dollar keep going up until recently dollar consolidate in a zone, because now we can notice the US inflation's already stagnant, and then it quite complicated, quite like contrast with the Federal Reserve member monetary policy decisions. Because if you are going to look at recently, US inflation's already start to slow down, which means that the Fed might be considered cutting their interest rates in 2024. This is what they mentioned previously. They say inflation, as far as US economy is not good, they want to cut the interest rates, and the first reactions that cause dollar is drop aggressively. But end up, due to the latest result from US, their latest economic performance, specifically inflation data, is actually not as bad as expected. The inflation is still high. Jobs reports in US is still good. That's why the Fed in the middle, they suddenly try to shift their perspective from the cutting interest rates in 2024 to maintain the interest rates. So you can notice most of the Federal Reserve statement are now talks mostly about maintain the current interest rates instead of cutting it. But compared during the 2024 January, the Fed keep mentioning they want to cut interest rates one. But due to now specific, the overall economic performance already changed. That's why they shift their view and dollar rebound back. Here is what they mentioned they want to cut the interest rates in 2024. That's why I keep dropping. And after that, start to rebound. Because Fed say they want to maintain instead of cutting it. All right. So just now we explained a lot about the inflations, but what is the definition of the inflations? So inflation is, in professional explanation, is inflation's measure average change in prices paid by consumer for goods and services. To explain in the layman terms is inflation equals to the price of the goods that everyone wants to purchase, the price of the goods that people want to purchase. So for example, if you notice the things that you want to buy become more expensive and more expensive, then this is how you feel the inflation risk. All right. So when inflation is very high, which means that we will getting poorer and poorer, especially when the US inflation, they claim that the US inflation previously, right, they hit 10%, which means that everything that they want to buy in US become 10%, increase 10%. So which means you become poorer by 10% lah, because if your salary not able to catch up the inflation rate, you will become poorer. So in order to solve this, they want to increase the interest rate. So remember, in layman terms, inflation is high. If inflation is high, they want to increase the interest rates. When they increase the interest rates, right, currency might be going up and vice versa. All right, you need to remember these terms. So this is how we understand on it. And then when inflation's when inflation is very high, what things is going to benefit from it? What can you invest on it? So for example, if inflation is very high, then for equity market, for stock market, you need to find some companies that are flexible for them to increase their selling goods one. All right, a very famous, maybe the very needy products. when the inflation is very high and then the company decide to increase the rate, but they won't reduce the demand, a lot of people still able to purchase on it. So this is how normally you can invest in that kind of countries lah. Very famous. Their products is still good. Even the price is high, still got a lot of people want to purchase on it. I leave it to you to find this kind of companies. But normally, if inflation is high, normal company will drop because their raw material become more expensive. But companies with pricing power, they will able to benefit from it. For example, let me think any monopoly company. Apple can consider one of the monopoly company. So when inflation is very high, they're able to increase the products and people are still willing to purchase on it. And then maybe another company should like sugar company that's selling sugar. A lot of people they need sugar. That's why no matter how expensive on it, people are still willing to buy. So you can try to search some like very important items, very important consumer products. So when you notice the news of inflation is very high, this company normally will be benefits from it. All right, or even Coca-Cola. So even Coca-Cola become more expensive due to inflations. If they want to increase the price, I believe that the people might still want to purchase on it due to their branding power. So this is how we analyze the equity market. And then the next thing is about the commodities market. So normally when inflation is high, investor will try to purchase commodity to hedge against the inflation. So to put in a simple term is when inflation is very high, which means that your own currency, their value dropping because things become more expensive, your money not able to purchase a lot of things. That means the value of your money can drop. That's why a lot of people don't want to hold money. They try to shift their portfolio towards others. So for example, commodities like gold, when inflation is very, very high, and if the Fed don't want to do anything, gold price will normally going up. And then the most famous products that I believe a lot of people have been experiencing before, the cryptocurrency. So when you believe inflation is high, your cash value of the money become lower and lower, no more value already. You will find another substitution, such as cryptocurrency is also one of the considerations that you can be hedged against the inflation. Because when value of money drop due to inflations, crypto due to limited supply, it becomes very good. So this is also able to explain why after COVID time, US inflation hit all-time high. The overall movement for BTC is still good. Same goes now. All right. And the third main thing is what we talk about the currency is the directly impact. So when inflation is very high, normally if the central bank don't do anything, their currency will drop. But we can notice this is the most hottest discussions around the world regarding on when the Fed decide they want to when the Fed saw the inflation is very high, and then the Federal Reserve will come out and say they want to increase interest rates. So this is the situations where inflation is high, the Fed decide they want to increase interest rates in order to control the inflation, their currency will normally go up. But the sequence is you need the bank to come out and say something lah. But if one country that when their inflation is very high, then if the Federal Reserve say that you can just ignoring it, then their currency should be dropping aggressively. Japanese yen is one of the considerations because as for now, their Japan inflation's wage growth already start to increase aggressively. Even the Bank of Japan come out and say they want to increase the interest rates. They keep mentioning they want to increase the interest rates. They actually did it one time by 25 basis points from negative interest rates increase until 0. But as a comparison between other countries, right, Bank of Japan, their monetary policy decisions are not as effective, not as easing, not as effective as expected. That's why, because of high inflation rate, but the Bank of Japan don't want to intervene their currency. This intervenes their monetary policy. This is the reason, and this is the proof. When inflation is high, but you don't increase the interest rates, Japanese yen drop aggressively. USD JPY increase aggressively. So this is what happens for the USD JPY recently. All right, because of high inflation, but the central bank decide to ignore it. As compared with Federal Reserve, when US inflation is very high, the next day the Federal Reserve member will come on and say, oh, because high inflation, we are expecting to increase the interest rates. That's why dollar go up. Compare with Bank of Japan, Japan inflation is very high. Then next day, Bank of Japan just say they want to increase, but just talks only. They do not implement anything yet. That's why markets buy it as high inflation, but the central bank don't want to do anything. Their currency is going to drop aggressively. So Japanese yen, JPY drop aggressively, USD, JPY going up a lot. So this is what happens in the market right now. So remember, don't complicate the sequence. When inflation's high, you need the central bank to come out and say they want to increase the interest rates, then their currency will only going up. There will be chances on it. But if inflation is very high, the central bank do not do anything, which means that the value of the currency is going to dropping. So appeals such as like gold market, crypto market will be benefits from it because the paper money, their value become not can consider not that worth already. So their currency will normally drop, and then gold market like crypto market might be going up. But if their currency, their inflation is high, they say they want to increase the rate, then normally the currency is going up. So you need one more step to decide whether the currency is going up or not if you want to analyze about the inflation. So inflation high, you need to understand what the central bank want to do and what's the next step. All right. So I hope I give you guys a clear understanding. Why I'm keep mentioning about the inflations is because this is the hottest topic that we have been discussed around the world, including the Federal Reserve, the ECB, European Central Bank, Bank of England, Bank of Japan, Bank of Swiss National Bank, Reserve Bank of Australia, Reserve Bank of New Zealand. They are all discussed about inflations, interest rates, inflation, interest rates. So I hope I clarify on it. So when they discuss about this thing, how can you strategize your trading strategy? All right. Now you already get a brief understanding about what is inflation. Inflation is just a very big picture of price of goods sold. But next thing, we will try to categorize 3 inflations report. So inflation is one big thing, but below the inflation, we do have 3 types of inflations. First is what we call the consumer price index. Most important inflation report. Next thing is what we talk about the producer price index. Then the third thing is what we call the core PCE price index, PCE. All right, this look like complicated, but here is a summary for you guys. So first thing, what is CPI? You can understand CPI as consumer inflation. Then normally they will measure the price of the final goods sold. So for example, if I want to so if I want to clarify how much is the inflation of the car, right? If you look at the consumer price index, they will look at the final products of the car. The car already fully built. So the price of the car is what we call the consumer price index. Try to identify it, the final goods. But producer price index, PPI, is different. PPI is what we make sure the cost of the raw material. For example, it's not the final goods of the car that we classify as the inflations, but the material that used to build the car, for example, tire, for example, aluminium, for example, mirror, this thing. This is what we mentioned about the PPI, the producer price index, the raw material that we use to build the car is the prices, is what we call the producer price index. The producer inflation is the raw material of the products. Consumer price index is the final products, final goods product. So normally people will be like, if the PPI data is high, producer inflation is high, raw material is expensive, normally this will also cause the CPI data to be increased one. But normally, a lot of traders, investors will likely to focus on the final goods of the products. So because final goods of the products will normally highly linked with the demands in the market. So for example, consumer price index is very high, which means that a lot of people are purchasing the final goods. So no matter how expensive it is, they still want to purchase. So consumer price index should be more solid and bigger movement compared to PPI. So for example, you want to look for the car prices, right? You are not going to look through all the car material prices, what is the tire prices, right? You just look at the final goods of the car, the price of the final goods. You just look at the price of the car. So same go with the trader and investor. They just look at the prices of the final good, which what we call, we just focus on the consumer price index. Okay. And then the next thing, the third thing that we will talk about is the personal consumption expenditure, PCE. Is a combinations between CPI and PPI, both. And then this data will normally focus by the Federal Reserve. Federal Reserve will keep looking at whether the PCE data is high or not. Then the next step, as I mentioned just now, they will likely to decide what should be their interest rates decisions. So if PCE is high, Federal Reserve member come out, they say they want to increase the interest rates, then the currency will be high chance to be going up. Or previously, the Fed already mentions, we will look at the PCE report to decide whether I want to increase the rate or decrease the rate. Then PCE report is very important. Normally, after PCE reports release, investors will just rushing and enter into the markets. All right, so this is how we understand and classify these three different economics data. And then the next thing, which is what is the final data that we can be focused on it, what we call the employment data. Employment is simple and clear, just very, very simple. So we do have tons of the employment data, but already classified these four major employment data for you guys. The first thing is regarding on the initial jobless claim. Initial jobless claim is those who don't have any jobs, they go and claim from the government. So if initial jobless claim is high, which means that a lot of people are jobless, they go and claim a lot of money from government. Or layman's terms, high initial jobless claim normally is bad for the economy because a lot of people are unemployed. So unemployment rate is simple. High unemployment rate means more people don't get any jobs. That's why the economic outlook is not good. Non-farm payrolls, NFP data, every month, first week of the month, we will conduct a webinar. If you're interested, you can also feel free to join us about the non-farm payroll. All right, so this is very important for us to focus on it. If NFP is good, then normally the currency is going up and vice versa. Average earnings index plus bonus is what we call the salary. So if this data is high, means that people who request the salary increments in the United States is good. So we'll normally also give a very good economic prospect. So normally because salary increment is good means your boss earned a lot of money. So your boss earning a lot of money, it raise your salary and you will use the money and spend more of your money. The economic conditions in that country should be very good. Their currency will normally go up. All right. So this is how we justify on it. Just one special thing, which is what we call the initial jobless claim, a bit difficult for us to understand. But just remember, high initial jobless claim means it's actually bad because there are more people to claim unemployment benefits from the government. It's normally not good for the US dollar. All right. So for jobs report, it's simple. We just refer to non-farm payroll, initial jobless claim, unemployment rates, and these three should be very good for you to identify how should be the job sector performance in the United States. When job sector is good is when the unemployment rate decline, non-farm payroll increase, or fewer jobless claim. So this will indicate a very strong labor market and economic growth. So normally, if you look at this data is going to release, there should be a significant movement. So if you are interested, every first week of the month, you can feel free to join our NFP webinar. We will conduct and together we will look through and analyze about the data, and then we will try to have a short analysis on the post data event. After the data release, what happens in the market. All right. So if the job data is good, then equity market should be benefit from it because people become richer, they spend much more money. It's good for the financial growth. Currency will normally going up if the jobs performance is good because that economic outlook is good. It will attract a lot of capital inflow in that countries. And then we do have the commodities. A good NFP result will normally cause dollar going up, and it might be also cause gold price to drop further. And if job data is good, then it might be also indirectly increase the prices for the oil. So this is how we analyze on it. So I already summarized the few crucial economics data that you can be focused. And then after the webinar end, I think the next 2-3 days, you guys will receive an email, including the recording, including the PPT. You can refer to it and make small summary for all of you, like what is the importance data. Economic growth, we can identify by GDP, PMI reading, retail sales, jobs data, NFP, unemployment rate, average earning growth rates, initial jobless claim, net inflation, CPI, PPI, and PCE price index. A small summary, I hope that can help you prepare on it. All right, so now we are going to look at the case study for after the release of consumer price index during the 1st of April. You can notice 1st of April, 8:30 p.m. GMT plus 8 CPI data release. So you can notice, see this CPI data, consumer price index data, after they release 3.5% higher than the market expectations. So because CPI data is what we call the inflation data, and then the Federal Reserve member keep mentions that if inflation data is high, they will increase interest rates. So that's why after the CPI data release, dollar going up, because investors already know if the inflation data is high, the Fed wants to increase the rates. So they will just identify the data, they notice that, oh, this data is high, so they purchase dollar and they short sell on the gold market. So this is what we call the gold market. So data is good, economic performance US is good, and then investor will also shift their portfolio towards high risk asset. They sell off their safe haven gold. So this is a proof that you can notice after the CPI data release, gold actually dropped around 2,700 points, a very huge drop. So if you are a new trader, you just like 5-minute charts, maybe around 5 minute to 10-minute movement, you can notice this is a very high risk event. So as a new trader, you can try to avoid it, but if you seek for excitement, you can try to experience with it. This is just one of the example. Yes, our time are limited. So you can find a lot of these kind of cases in future. Remember all of the CPI data the data I show you here. Normally all of this data release, after they release, the movement is very huge one. So you can refer to it. All right. So I hope you guys have a lot of understanding about what is all these crucial economics data, and then what is this like, what is GDP, very important, what is inflation, what is employment. And I hope you guys also understand that if this data is good, what can we invest on it? And then finally, we will try to prepare you on several things. Prepare you, for example, like what is the GDP, like what is the economics data that you need to focus later this week. So in this week, we do have a lot of crucial economics data, mostly from the United States. The first data should be regarding on the GDP data. As I mentioned just now, GDP will try to signal how should be the economic performance, how rich in the country, how rich in the United States. So it's very important that for us to focus. Initial jobless claim also important. Remember, initial jobless claim, higher reading means it's bad for the country because a lot of people don't have jobs that claim from the government. GDP, the higher the better. Higher GDP, country become richer. So don't like confusing between these two. GDP, the higher the better. Initial jobless claim, the higher the worse. So not only GDP data release is important, you can notice on Friday, we do have the core PCE price index data, the inflation data. So because now the Fed already mentions that if the inflation data is high, they will decide to increase the rates. So dollar might be going up if inflation is high. So you can monitor on the core PCE price index. If this data higher than the market expectations, there will be chances for the dollar to go up. Then there will be also chances for the gold price to drop in further according to historical price movement. So you can monitor on it, but of course, sometimes unexpected things will be happens. So even you are correct, but please consider some stop loss strategy or risk management strategy is important. So even though you understand the full theory, but sometimes market will give you some of the surprise. So risk management is important for you to focus. So kindly reminder, GDP data going to release tomorrow. Core PCE price index, very important, a huge movement also. These two is very important. So stay tuned on it and be prepared on it after the data release. All right. So I think this is all of the covering sections for tonight. So thank you.